Hey everyone, and welcome back to the Tesla Stock Podcast. The shareholder vote is over, the trillion-dollar pay package is approved, and the mandate is clear. Tesla is officially pivoting to become an AI and robotics company. But now that the easy part, the voting, is done, the hard part begins. What does this new AI-driven Tesla actually look like? What will it take to get there? And why are some of the biggest bulls, like Cathie Wood, suddenly selling? As the stock now trades around the $436 mark, we need to talk about the $8.5 trillion roadmap and the hardest year that's coming. Let's start by looking at what shareholders actually voted for. What is this $8.5 trillion company that Elon Musk is being paid to build even look like? A new analysis from Barron's this week did a fantastic job of breaking it down. To unlock his full, nearly $1 trillion package, Tesla has to achieve some truly massive goals, culminating in an $8.5 trillion market cap and $400 billion in annual EBITDA. Now, $400 billion in EBITDA is an almost unfathomable number. For context, Tesla is expected to generate about $13 billion in EBITDA this year. This means the company's earnings would have to expand 30-fold in just 10 years. But here's the key. If Tesla does pull this off, its valuation would, for the first time, actually make sense by traditional metrics. Today, Tesla trades at a wild 100 times EBITDA, but at $8.5 trillion and $400 billion in earnings, it would trade at around 18 times EBITDA, right in line with the Magnificent Seven stocks like Google, Microsoft, and Apple. So the vote was essentially a bet that Tesla can transform from a high-flying, speculative stock into a mature, cash-printing machine just like the other tech giants. But is a 30-fold EBITDA expansion in a decade even possible? Well, as the report notes, there is one precedent. NVIDIA. Before the AI boom, NVIDIA was generating around $5 to $10 billion in annual EBITDA. Wall Street now expects them to hit $190 billion in EBITDA by 2027. That's a 30-fold expansion in the blink of an eye. The bull case for Tesla is that it will use NVIDIA's chips to create the AI applications, the robotaxis and robots, that will do the exact same thing to its own income statement. So how do you achieve a 30-fold expansion in earnings and build an army of robots? That brings us to our second story, the human cost of that vision. According to a new report, Tesla's vice president of AI software, Ashok Eluswamy, held an all-hands meeting last month for the company's most important employees, the Autopilot and Optimus teams. His message was a rallying cry. He told them that 2026 will be the hardest year of their lives and that they should expect to work more intensely than ever to achieve the company's goals. This is the execution risk behind the bull case. The company is setting incredibly aggressive timelines to make the $8.5 trillion vision a reality. This includes operating the robotaxi service in 8 to 10 cities by the end of next year and starting production of the Optimus robot by the end of 2026. This isn't a normal 9-to-5 operation. The Autopilot and Optimus teams are known for working longer hours, and Elon Musk himself has said his weekly meetings with the Optimus team sometimes go until midnight on Fridays. This is the internal war that has to be won to justify the stock's valuation. The trillion-dollar pay package is the incentive, but this hardest year is the actual work required to get there. This massive execution risk is not lost on investors, not even on the biggest bulls. That brings us to our final story. This week, Cathie Wood's ARK Invest, arguably the most famous Tesla bull on the planet, sold shares of Tesla for 4 consecutive trading sessions, unloading a combined total of over $30 million worth of stock. At the same time, a regulatory filing showed that Elon's brother and Tesla director, Kimball Musk, also gifted nearly 15,000 shares. Now, before anyone panics, let's put this in context. This is not Cathie Wood abandoning her thesis. Tesla remains by far the #1 holding in her flagship ARK-K fund, making up nearly 12% of its weight. Her firm still has a 2029 price target of $2,600 per share, and they've stated that they believe 90% of Tesla's 2029 value will come from the robotaxi business. So why sell? This is most likely prudent portfolio management. ARK's strategy is to trim its biggest winners when they rally, and Tesla has had an incredible run, up 72% in the last 6 months. It's smart to take some profits and rebalance. But this selling is also happening at a moment of technical weakness for the stock. This week, TSLA sank more than 4% in one day, retreating further below its 50-day moving average. The stock has been choppy and is down about 5.7% for November so far. The sugar high from the shareholder vote is over, and the market is now waiting for the next real catalyst, which is Elon Musk making good on his promise to remove safety monitors from the Austin Robotaxi fleet by the end of this year. Until that happens, the stock is in the show-me phase, and even the bulls are taking a bit of risk off the table. So to sum it all up, the new pay package has laid out a clear 10-year roadmap for Tesla to transform into an $8.5 trillion Magnificent Seven-style company, a goal that will require a 30-fold expansion in earnings. Internally, the company is bracing for this pivot, with leaders telling the core AI teams that 2026 will be the hardest year of their lives, as they face aggressive deadlines for robotaxis and Optimus. And in the short term, even the biggest bulls like Cathie are trimming their positions, managing risk as the stock pulls back and the market waits for the next major proof point in the autonomy timeline. This brings me to my question for you. What do you make of this hardest year rallying cry? Do you see it as a sign of a focused, hardcore culture that will do whatever it takes to achieve the 8.5 trillion vision? Or does it concern you as an investor, suggesting a potential for employee burnout and a high-risk, high-pressure environment that might not be sustainable? Let me know your thoughts on this execution risk in the comments below. As always, if you found this breakdown valuable, please hit that like button, subscribe to the Tesla Stock Podcast, and be sure to turn on notifications so you never miss an update. Thanks for listening, and we'll see you next time.